Property joint ventures can be the key to changing your life, building your property portfolio, even if you don't have any money. Now, you might be wondering, what on earth are joint ventures? How can you do them? And are they even legal? Well, in this video, I share all. Joint ventures help me to build my own portfolio, and it can help you do exactly the same. The way you do it is by providing a win-win situation for both yourself and the other party. So I'm going to take you through exactly how you do that and what value you can provide and how you can even do it with none of your own money. So first we have to cover what is a joint venture. Well, typically that is between two parties in a 50-50% split. And the idea behind it is that one person's putting in the money, one person's bringing the deal and doing all the work. So there's kind of three dynamics then in a property investment. It's time, money and knowledge. And the idea is that the person doing all the work has the time and the knowledge, but the other person brings the money. So this is how I've structured things, that I had the knowledge and I had the time, whereas the investors were time poor, but they wanted to make a return on their investment. And now when they're getting barely anything in the bank at 0.1%, when I'm offering up to 8% returns, it kind of seems like an attractive offer. They know that I know what I'm doing, and that's what really gives them the confidence and build a good relationship with them. Typically what happens is they split the generated cash flow between them along with the capital growth in the uplift of the property when they either do buy, refurbish, refinance, or whether it's a flip and they're just splitting half of the profits between them. Then that could be the option that they choose. It really depends. Joint ventures can be structured in lots of different ways, and I'm going to cover that a bit more of that in detail. The other side of things in a 50-50 partnership is where they go truly 50-50, where they put in half of the money each and then they do everything together, but that's where there's more equal weighting. So there are the typical kind of joint ventures that most people would say, but the other one was where I had the time and knowledge and had the effort that needed to be put in to make sure that they got through. So that's from the acquisition to the refurb of the property to getting it through legals to getting it let out, all of that aspect of it. That's the bit that I was able to do. Well, that is the way that I was able to accelerate my portfolio. My preferred method of joint venture is a fixed interest term loan. So the idea is that I'm lending the money from an investor. Usually these people are time poor, cash rich, they have money in the bank and it's not really working very well for them. So typically it's in an ISA or it's just in their bank, sat there earning them all. So the idea is that I'm lending that money, giving them security that I'm going to either back it up by a charge on the property, which is the same as a mortgage would get. The charge that they would get on the property is the first person to have access to the money if the property was to be sold, and then give a personal guarantee. The personal guarantee is there to protect them and is to come after me personally, and it's not in a company, so they can come after my assets and I have assets there that they can then sell off and get their money back. So the idea is that it's pretty secure, a lot more secure than if they were investing in the stock market or crypto, might I add. But the idea is that because of that security, they get a fixed interest term loan. So the idea is that after whatever it is, a 6, 12, 18 month, 24 month period, they're getting their money back at a fixed % interest. So for example, if I lent 100,000 over 12 months, I would give them the £100,000 back, and I would give them the 7 grand from that 7% interest. So it's much better than just being in the bank, and that's the way that people see it when they're investing with me. They have the knowledge that I can do it and the security then because of the personal guarantee and the charge, or one of the two. The idea is that they can contact me and they are interested in property in most cases, but they don't have the time and effort to do it, so it might not be right for them. Also, we're looking at doing a earn and learn system where I'll be taking them through in this kind of similar situation where we're joint venturing and we're taking them through the whole entire process. They're going to invest a fixed % interest and they're going to have all of that security whilst they're going to learn the entire process so they can get their first buy to let, so that they can start really understanding the strategy of buy to let, or if it's they're just getting into buy, refurbish, refinance, we're going to take them through the entire process from acquisition to the solicitors to getting the property refurbed and then let out. So they're going to take the way through the whole process, and that's the kind of method that we're starting to use, and that's the typical joint ventures that we go for now. So what you want to know then is, how can you benefit from this? Well, I've taken you through my experience of joint ventures, but how do you benefit? The idea is that what you're going to do is, if you've got money, then you can invest in someone who maybe has the time and knowledge, or if on the other side, you're on the side where you don't have the money, but you do have the time and knowledge, then you can go and invest. That's about building trust and rapport with these investors so that you can joint venture on projects. And talking about the different structures that I just talked about, that can be the way that you can start building your portfolio. So that might be the way that you can start accelerating, and it can completely change your life as it has mine. One thing that I do want to make you aware of is the compliance aspect of it. So now when you are doing a joint venture, it's subject to FCA compliance. That's Financial Conduct Authority. Now what you need to do is look at 13.3 compliance. The idea is if you are investing with someone, they need to be compliant in the sense that they either have to be a high net worth individual or they have to be a sophisticated investor. Now, passing that criteria is really, really important, because that makes sure that you are going to be compliant and you are above board and everything's legal. Whereas if you do what I said on the fixed percentage interest loan, they don't have to be any of those things. So if you are doing that, that's much easier strategy to get started, because you don't have to go through the FCA stuff. But if you are going to check it out, check out 13.3 FCA compliance. I might be able to link it below as well, or above in the video, so you can go and check that out. You might be wondering, what do I need to be aware of when going into a joint venture? Well, essentially, you're going into business with someone at the end of the day, so you need to make sure your missions and values align. Now, there's no good going into property with someone that has a different kind of goal and end goal to you. For example, if somebody wants to flip property and you want to hold it for the long term, that's going to be conflicting, and you're never going to really build that synergy to go forward, and it might not be a right fit. But that's fine. It doesn't always have to be a right fit. You're going out there, it's a bit like dating, finding the right JV partner. Well, it's not quite monogamous, because you can have multiple partners, but the idea is that you're building a long-term relationship with them, and you want to be doing these deals for a long time. So you only need a handful of these investors to really start building your portfolio. If that's the case, then you need to really look at it and make sure that you're choosing the right people for the long term. Bearing all that in mind, how do you find these people? Well, the first place you can look is networking events. You can look at training events, some other training that you're doing, get connected with people. You can go and build a list. So one of the things that I was doing was building a list of property investors through my background in marketing and advertising. So lead generation, looking for people looking to invest in property. That was a good way of doing it. Being active, telling people what you do. Friends and family are probably the easiest people that you can go out and connect with, and they're going to have that trust instantly instilled in you, unless you've been a bad person, obviously. I'm only joking. But the idea is that you're going to be able to build trust with people who already know you. Maybe you've had some other achievements, you've built businesses, whatever it is. They might have that trust in you instantly there, so that can help you accelerate that kind of relationship building and make sure they have the trust to invest in property with you. The next thing to do is make sure you have contracts in place. I know everything seems rosy when you go into a partnership. You've got big goals and aspirations for what you're going to achieve, but they can come crashing down quicker than you know it. And I've learned from experience with this. So make sure that you've got contracts in place. Make sure that you really understand what the goals of the other person is, and you really need to test and trial your relationship beforehand. That's just a really key insight. If I'm going to do something, I don't want to do something that I'm going to lose a lot of money on. Try something smaller, then build up. I know that that's kind of typically not what you want. You want somebody to dive right in, but they might just be testing you out, put in smaller sums of money in, just to know that they actually going to get their money back. And then they might come back and then hit you with a lot of money. And that's happened to us. It's just because they want to test out the relationship. So don't be discouraged when somebody says, I can give you maybe 10 grand. Use those people, because they might just be testing you out, or they might be there, they might have more money one day and they would trust you in maybe over even their pension, which has happened with us. So look at that. Is it going to be something that you need to do, and build the contracts in place so that you have almost the shareholders agreements, you've got other contracts in place. They're really, really important. Terms in which you're going to lend the money, personal guarantees, all of this kind of stuff needs to be in place to make sure that you're having an effective joint venture partnership. When things go wrong, they can go very wrong, but these are the things you need to be aware of. If you are misaligned, which I talked about earlier, then things can go crashing down. And I know I mentioned it about having contracts in place and everything like that, but really it is so, so important. I'm going to just mention it again, because if you don't have those kind of things in place, and particularly what you want to look out for is the goals that you have and the alignment of where you want to go. Like I said, don't go into somebody who's looking to flip and you're looking to hold for the long term unless that's part of your strategy. But you've really got to be aligned in that. The next thing is make sure you like the person and make sure they're actually going to bring something to the table. I mean, money is one thing, but I want to make sure that I like the person I'm lending the money off. It is an absolute nightmare working from the experience with clients in particular. People who have come and then ask you lots and lots of questions, and you're not really aligning, and you know what's going to be a good fit and a bad fit. It's down to the dynamics of your personality are really important with this. You might be looking at somebody who's super analytical, and you might be quite an extroverted character who's not so much that way inclined. Well, that can be a nightmare because somebody's going to be looking for the details, but that might not be you. But then you look at it, that is one of the things you really want to know is, are your personalities going to match up? Is it kind of the same kind of personality you have? I like having slightly different personalities, but they can be completely polar opposites that really don't work well, and one can rub the other one up the wrong way. It's better when they have a kind of similar personality, or there are similar aspects to their experience where they have an understanding. That's the kind of best situation where you have differences, but those differences are complementing each other. Ultimately, you need a contingency plan. What happens if things go wrong? What is option A, B, and C? And believe me, things do go wrong. I always have a backup option. I always have another exit, and I'm always presenting that to our investors so they know that I have thought of the possible outcomes that could happen. So for example, with a property, if I'm going into it and I'm thinking I'm going to rent it out, well, what is the kind of other options that could be there? How can I rent it out? Oh, I couldn't rent it out in the typical way. It's maybe something that people are not wanting to rent out. In fairness, everything's renting out at the moment, so that's not too hard. But I might change strategies. I might decide that I can flip the property and sell it, even though that I might be making less money. It might be the thing to do at the time. Could I change it into service accommodation? Could I look at title split in the property to then turn it into 2 flats? There are other options there. Could I add an extension that would really bolster up that capital growth in the property? Is that a strategy that I could use to make things more efficient? And I've got an exit plan. So these are the things that I consider is something that you should. A, B, and C. I always think A, B, and C options, even more if you can. And as a part of contingencies, what happens if the market crashes when you're doing a project? What happens if interest rates rise? Have you thought of that? Have you stress tested your figures to make sure that it still works even in a falling market or a high interest rate market? Some of the things to consider. One of the things that I also make sure that we're considering is the level of communication. Breakdown in communication could be the breakdown of a deal. I mean it, honestly I do, because if you don't communicate, it can have everybody's back up and it can really be a stressful time for both parties. If I don't know if the money's going to come in, for example, then I could be really stressed for that reason. They could be similarly stressed because they don't really know what's going on. It could be that you haven't spoken to the person in 2 weeks and you're lending 100 grand off them. Now, think of it the other way. How would that make you feel if you hadn't heard from someone for 2 weeks and you're lending them 100 grand? Yeah, you would be stressed, right? So communication with this kind of sums of money are really important, and making sure that you are consistent with your communication so everybody's aware of what's happening. Making sure that is really, really crystal clear is the key to making sure that you have a successful partnership. When thinking of joint ventures, those are the things to consider. I've shared my personal experience, obviously, of joint ventures. I've shared exactly how you can start using joint ventures to grow your portfolio, even if you don't have any money. I know there's probably more questions, so please do ask them in the comments. Don't forget to like, comment, and subscribe on this video. And if you're interested in our Earn and Learn program, put Earn and Learn in the comments and we'll reach out to you.